Okay, so just picking up with this financial accelerator idea. So what this does is to help us explain how if we're at a tipping point, if we're at the unstable equilibrium in the housing market, to kind of explain why a small shock could push us to the high price stable equilibrium or the low price stable equilibrium. And it's all linked to the idea that housing can be seen as collateral, right? Housing can be something that you can use as collateral if you want to borrow money. And so we've got these two cycles, these two diagrams, which show us how we could get to the high price equilibrium, how we could get to the low price stable equilibrium. So if there's some shock which causes a house prices to increase, that means now everyone who owns a house has a higher value to their collateral. And if you have more collateral, that means potentially you could borrow more money. Right? So if your current house is worth more, that means if you're thinking about buying a new house, you're going to be able to borrow more. And so that could lead to people then going out and buying a new house. And so that's going to increase the demand for houses, which then pushes the prices up even more. And so you can see here a very clear positive feedback process. That initial shock of pushing prices up, increased collateral, and then increases the demand for housing, which pushes prices up again. We could have a similar thing if there was a shock to house prices, which pushed the price down, right? Lower value to your collateral. Therefore, you're thinking you can borrow less against the value of your house because your house is worth less. And that means, okay, maybe I'm not going to go out and buy a house now because my house that I currently own has fallen in value, and less demand therefore for houses pushes the prices down even further. So we can see here two clear positive feedback processes which get us to the stable low price equilibrium and the stable high price equilibrium. And we use the term accelerator because you can see that the kind of increase in the house price, that shock kind of pushes up collateral or if there's a negative shock, pushes down the value of collateral. And then we kind of move further and further and further away from that original unstable equilibrium. So we accelerate away from it. And the key reason being the houses can be seen as collateral. So I think these bullet points underneath, they kind of bring in a different point. They bring in this idea that actually this is also tied into aggregate consumption behavior, and for a very similar reason. So if we think about two types of individuals, those who are not credit constrained and those who are credit constrained, well, in both cases, what might happen to their aggregate consumption if the value of a house increases is kind of the same. So if you're not credit constrained and your house becomes more valuable, you have a higher net worth, your wealth has increased, maybe relative to your target wealth, and therefore you're thinking, oh, well, maybe I can get away with saving a bit less. So if I'm saving less, then I'm going to spend more. So increases consumption for individuals who are not credit constrained. And even for people who are credit constrained, right, so they can't really borrow much, but if the price of your house goes up, then actually maybe you are going to be able to spend more because now that your house is worth more, you have more collateral, you could borrow more, which allows you to increase your consumption as well. And obviously, if house prices fall, then we see the opposite effects, right? Not credit constrained households are going to increase their precautionary savings. They're going to save more, and people who are credit constrained are going to be able to borrow less now because their house is worth less, so they have less collateral. So that's what the last bullet point is getting at. Although I do think there's a typo. It says the house price collapse will have an amplified effect on aggregate demand as households dissave in order to rebuild their wealth. So I think that should be households save in order to rebuild their wealth. Okay, so that's our financial accelerator part. So this next bit that I wanted to touch on is a table which kind of shows us how the housing market ties into the banking sector and then how that can tie into other sectors of the economy. And just shows us how kind of crucial, how central housing is actually to huge parts of the economy because of this connection with the banking sector. So the first thing to look at here, falling house prices, how could that affect aggregate output and employment? Well, if house prices fall, then construction industry are going to think, okay, there's less money available here by selling houses, so we're going to maybe build fewer, and then profits are going to fall in the construction industry as a consequence. And then the second thing we've already seen if house prices fall, that means the value of collateral falls, so we've got lower consumer spending. And if households in the construction industry think these things are going to happen in future, think this is going to carry on, that house prices are going to maybe continue falling, then actually the consequences could be kind of worse into the future, right? That if there's lower consumer spending, that means there's less demand for goods in across the economy, and that if there's less demand for goods, that means maybe fewer people employed, and therefore fewer people with income, and that's going to have a knock-on effect of reducing consumer spending even more. And then on the construction industry side of things, well, if they kind of carry on thinking prices are going to fall, they're going to reduce the amount of people that they're employing, and that's going to have a knock-on effect across the economy as well. Now, the next sort of channel, falling house prices and the financial sector. So typically, banks are the ones who give out mortgages in order so that people can buy houses. Now, why are we going to get more mortgage delinquencies and foreclosures rising? Well, if house prices fall, and you think then people who own the houses, they have less collateral, and maybe that means it's harder for them to borrow money. And possibly they were actually borrowing money in order to be able to afford to pay their mortgage. So now they can't borrow so much money, maybe they can't afford to pay off their mortgage, and they become delinquent, as in they're failing to make repayments. So we see mortgage delinquencies rise. And then foreclosures, this is where the bank then seizes the house, they seize the collateral. So this is obviously bad for the homeowners, but this is also kind of bad for the banks, right? Because they've lost out on these mortgage payments that they were supposed to get. Now, they could sell the house, but selling the house in a market where house prices are low, that could be bad for them. So in terms of the bank, they've got some losses because they're not getting these mortgage repayments. And then what if the bank has also bought into mortgage-backed securities, so assets which have lots of mortgages kind of packaged together? Well, the combination of these two things, banks losing out on mortgage repayments from like homeowners, but also seeing the value of these mortgage-backed securities fall, that could lower that net worth. Why does this then have a further knock-on effect? Well, credit availability to the construction sector falls, right? Banks are going to think, we don't have so much money anymore, so we are going to reduce how much we're going to loan to the construction sector. And you can see this could get worse and worse and worse as well. So let's go on to the next little bit. So from the financial sector to the real economy. So if banks start to get into weaker positions and start to lend less money, not just to the construction sector, but across the economy, this is obviously very bad, right? It becomes more expensive to borrow money, right? Cost of borrowing rises because banks are now thinking we're going to charge higher interest rates because we're a bit worried about, getting the money, getting those loans repaid. And then that could have an impact on investment in new housing. So actually, it could be that construction sector finds it even more difficult to borrow the money to build new houses. And then this last bit, impact on consumption via tighter credit and lower financial asset values. So if banking assets are worth less and also banks are making it more expensive to borrow money, then definitely consumption is going to fall, right? If there's tighter credit, it's hard to borrow, that's going to reduce consumption. If people's financial asset values have fallen, then they're going to increase their precautionary savings, right? They want to try and rebuild the wealth that they had, and that they feel like they've lost some of that wealth because their asset values have fallen. So this is all going to reduce consumption across the economy. And then I think the last bit, from the real economy to the financial sector. So fall in GDP and household incomes via the multiplier process causes a further drop in bank profits. So I guess the idea here is if you have people people losing out on income because there's less output required, and so more people are losing their jobs, or simply people are keeping their jobs but they're getting paid less, then that means actually there's just less business for banks, right? There's less people who want to borrow money, less people investing, and if there are fewer people doing those things, then banks are going to lose out on profits. So you can see there is this real huge connection between housing and the banking sector and the whole economy. And one final ingredient to this is, what about the government, right? And why the government are relevant to this is because if a bank fails, then typically governments will step in to bail out the banks, to stop them from collapsing, and maybe to kind of guarantee the deposits that depositors have in the bank. But there is a risk with this, right? And we see this cycle here, which kind of outlines this. So if governments kind of are willing to bail out banks, and they've done that in the past, well, then within the financial markets, the financial market participants, so those who kind of own the banks, or people who maybe have money in banks or have bought bank assets, they're kind of thinking, well, if things go like really wrong, we know the government are going to bail out the bank, right? Now, within the bank, knowing this makes it more likely that banks will make risky decisions, kind of thinking, well, if it doesn't pay off, the government will step in and help us out. But banks making risky decisions makes it more likely that banks will actually fail, and makes it more likely that governments will have to step in. And we've seen through the table above that if problems happen in the banking sector, right, and they could be more likely to happen if you have the government here as a sort of person to bail them out, then we have this external effect that causes damage to the wider economy, right? If banks start to fail, then that means less credit available for businesses, less credit available for households. So falls in consumption, falls in investment, falls in aggregate demand, more unemployment. So this really could have a massive knock-on effect on the whole economy. So how can we try and prevent these kind of things from happening? Well, you've got two suggestions here. So the first, raise capital requirements for banks. So they need to have more capital, right? And what does that basically mean? That they cannot make such risky decisions, right? They cannot kind of use the money that they have to make like really risky bets, because they have to keep a certain amount of capital available at all times. So that's one way to try and basically stop them making such risky decisions, and stop lower the probability that banks will actually fail. So that's one step you could take. Second step you can take, what we refer to as resolution regimes. So if banks do fail, we try and make it so that they fail in a way which is not going to damage the rest of the economy. So things like making it so that the first people who suffer are the shareholders of the bank, right? That they don't get any dividends, or like they are going to have to take a kind of cut on any money that they're expecting. So resolution regimes are just a way of making sure that banks can fail in a way that does not then have knock-on effects on the financial market, and therefore doesn't have effects on the wider economy. Okay, so I think that is another good place to take a pause before we then go on to the last bit of this, which is seeing how we can think about dynamics curves in terms of the environment. Okay, so the final section of this economics dynamics unit is to kind of come back to the climate and see how we can use this model to think about, well, two things. One is the level of sea ice or summer sea ice, and then later on, thinking about the adoption of electric vehicles. So here we've got a diagram which shows us an S-shaped dynamics curve, the environmental dynamics curve. And this is actually a really useful way of thinking about what happens to summer sea ice levels over time. So with this, we kind of imagine at the moment that we are at this point B, right? A stable equilibrium where there is lots of summer sea ice. And we can see point B, it's on that 45-degree line, which means the level of sea ice that we have, say, this year is going to be equal to the level of sea ice next year. And if we fast forward to next year, then we're in that same place. And so this just carries on, right? We carry on with the same kind of amount of sea ice every single year. Now, if there was some sort of shock, right? If there was a shock that led to a year where there was a lot less sea ice. So imagine there was some, freak, really, really hot summer, so that the proportion of sea ice, so let me label S1, the like normal level, where we fall down to some level S2 here. Well, we can go through the same kind of analysis that we saw with the housing market to see that what would happen actually is that the next year, well, that we would start moving back towards our stable equilibrium, right? Just to kind of start that process off. So if there's a shock which pushes us down to S2, then we see that the following year, we would have sea ice at a level S3. And we can see S3 is higher than S2. How do I know that? Because S2, I can find it on my y-axis by using my 45-degree line. And so I can see the shock that pushes from S1 to S2 the following year will be back up to a higher level S3. So we'll be here. That is where S3 is. And then that's going to carry on again into the next year. And the level of sea ice is going to push back up and we're going to recover and get to point B. Now, how could we end up at the low stable equilibrium with actually year after year really not having much summer sea ice? Well, one way would be some enormous shock, right? So that, you know, there's a big enough shock that actually the level of sea ice falls below our tipping point level, right? If that happened, if there was a huge shock which caused a massive drop in the sea ice level, then actually we would fall all the way down to this low summer sea ice stable equilibrium. But what's also possible, what would also make that more likely to happen, is if actually this environmental dynamics curve started to shift downwards, right? So if we see the environmental dynamics curve shift downwards like that, then we'd have a stable equilibrium now here, which I'll mark at B prime, and an unstable one here at A prime. And you can see in this case, right, compare the levels of sea ice at our unstable and our stable much, much closer together, right? So if we're at S1 here, now a much smaller shock will get us past this tipping point and we'll fall to a low sea ice stable equilibrium with actually an even lower level than we had before. So what kind of thing could cause the environmental dynamics curve to shift down like this? Well, global warming essentially, right? So if we have, you know, climate change happening to such an extent that like year after year temperatures are going up and up and up, that could actually mean that, you know, if sea ice is at like a particular level this year, because temperatures are going up next year, we'd expect less sea ice that next year. And then we have a bit of a knock-on effect, right? Because when there's less sea ice, there's less reflection of the sun's rays, and therefore it makes it more likely that actually we're going to get even more heating. And then we get the sort of, I guess, bust possibility, right? If this environmental dynamics curve shifts downwards to such an extent that, say, something like this happens, right? So it shifts down so much, it's so altered by global warming that actually, you know, we're at point B here, and let's imagine that we get this big shift downwards of the environmental dynamics curve. Well, what's the impact going to be? Well, so here we start at S1, and then based on this new environmental dynamics curve, where are we going to be the next year? We're going to be at S2. Now, how does S2 compare to S1? Well, we can see that it is lower, right? And so we fast forward a year and we're here at S2. And then what's going to happen the next year? Well, we use our new environmental dynamics curve and we see we're going to go to S3, which is even lower than S2. And you can see we are making our way down the environmental dynamics curve, and we're going to keep on working our way downwards until we get to here, right? A stable equilibrium at a low level of summer sea ice, which is really, really low level. And so this is what we imagine global warming could do. It could actually kind of shift us. It could make it either easier so that a small shock would shift us to the low equilibrium, or it could actually, if there was a big enough shift down in this environmental dynamics curve, then it could actually lead to, you know, this really sudden, like basically like bust cycle where we just fall to a really, really low level of summer sea ice. So the diagrams underneath, I think that I've got here kind of show this process, right? Yeah, so you can see them underneath, exact same thing, that, right, a small shift downwards of the environmental dynamics curve brings our unstable equilibrium and our stable equilibrium at the high level of summer ice. It brings them closer together so that now a smaller shock could push us down to the really low level, or if the environmental dynamics curve shifts down enough, then actually we just get a big crash, right? We just suddenly get a massive jump without any shock. We just get a jump down to this low level of summer sea ice. So that's one use of this sort of S-shaped dynamics curve in terms of, I guess, climate change in the environment. The next one is to think about how we could use this S-shaped dynamics curve to think about increasing the rate of adoption of electric vehicles. So I will go on to that one next. Okay, so we're now going to use this dynamics curve idea to think about the adoption of electric vehicles. First key element of this is this diagram here, which shows us how the cost of operation of electric vehicles and carbon-based vehicles depends on the proportion of people in a country who own electric vehicles. So as we go from 0 to 1, this is showing us an increasing proportion of the population who own electric vehicles. Now we see that more people owning electric vehicles has zero impact on the cost of operating a carbon-based car, like a petrol-based car. And okay, that makes sense. But we see that it does lead to a lower cost of operation of electric vehicles. And we imagine that's for two reasons. One, if more people own electric vehicles, that's going to lead to an increase in the number of charging stations and the speed of charging to kind of keep up with the demand. And that's going to lower the cost of operation. And then also we'd expect if more people own electric vehicles, that the technology would improve to the point where it reduces the cost of operating them. So that's the first kind of key diagram. Now, our next key diagram is coming back to then an S-shaped curve. And so with this one, we kind of imagine we start here at point C, and where we want to get to is up here at point B. So we're at this carbon-based equilibrium where you can see the proportion of vehicles that are electric is quite low today. Let's again take this year to year. So quite low this year, and then it's going to stay at the same level next year. And then we fast forward to next year, and again, we're kind of stuck at this low level. And we want to think about, well, how are we going to get up to here at point B, where actually the proportion of electric vehicles is really high and stays really high? Well, before thinking about how we make the change, let's kind of think about why does this sort of model make sense, right? And so let's actually start down here. And looking at this, there's something kind of quite interesting, which is even if, right? So if I kind of carry this line onwards, so even if nobody owned electric vehicles this year, some people would buy them next year. So that tells us even if the cost, now going back up to this diagram above, so even if no one owns electric vehicles, and therefore the cost of operating one is much higher than the cost of operating a petrol car, some people would still go ahead and buy them. So that tells us there are some people who actually put a value, what we call a kind of green value, on buying an electric vehicle. And that green value they put on it is bigger than this difference between the cost of operation of the electric vehicle and the petrol car. But there are obviously some people who wouldn't want to buy an electric car under those circumstances, and are only going to buy it if the cost of operating an electric vehicle starts to get closer to the cost of operating a petrol car. And so let me now jump, before talking about the bit in the middle, let me jump to this bit. So if we get to the electric vehicle equilibrium, we see it's not at the point where everybody has an electric vehicle. And so that tells us, even when lots and lots of people have electric vehicles, so even when we're maybe somewhere over here in the diagram, where the cost of operating an electric vehicle is lower than the cost of a petrol car, even when we're over here, there will still be some people who want to own petrol cars. So these people you can think of as almost having negative green values, that actually they really hate the idea of having an electric vehicle, and even though it's cheaper, they would never want it. So we've got these two extreme groups of people, and then we obviously have a bunch of people who are in between, a bunch of people who maybe, as we kind of get closer to this break-even point, where they're thinking, okay, electric vehicles are still a bit more expensive than the petrol-based ones, but now the difference is small enough that I have enough green value that I'm going to go and buy an electric vehicle. And so we've got a bunch of people who are in the middle like that. And maybe we have some people over here, people who would think, okay, now the cost of electric cars, like, even though I don't really want one, even I don't have much green value, but I can see that electric vehicles are cheaper than running a petrol car. And so, you know what, the money thing takes over, so I'm going to buy an electric car. And I guess what we kind of see on this diagram is we have this key bit in the middle, this tipping point. This tipping point where if there was a big enough shock, so let's imagine this is where we're starting off, I'll call it like P1. If there was a big enough shock so that suddenly, like this year, enough people bought electric vehicles, right? So that actually we are to the right of the tipping point. Well, what would happen? Well, the proportion would go up and up and up and up and up until we eventually reach this higher equilibrium here. But you can see at the moment, that's going to require a massive shock. It's going to require like a really strong reason why suddenly lots more people would buy electric vehicles. But one thing which is interesting about the way that we model this is you can see that the tipping point is at a proportion that is below Z. It's below the break-even point. So what we're trying to put across with that idea is that actually, even if the cost of operating an electric car was still more than the cost of operating a petrol car, we would still be able to get to the higher equilibrium, right? Because we're kind of saying that there's enough green values in society that if we get close enough, if we get to the point where electric vehicles are similar, but still a bit more expensive than petrol cars, that's enough to push us over the edge. That's enough to start the process of getting to higher and higher proportions of people owning electric vehicles. So now let's do the same kind of analysis we did with the housing market and with the sea ice, which is thinking about what was going to make it easier for us to get from C to B. Because at the moment, we need a massive shock, right? We need a shock which is going to push us out past the tipping point. Just like with the other two, the thing that's going to make it easier to get from C to B, the thing that's going to make it easier to move from one stable equilibrium to another is if we have a shift of the dynamics curve. In this case, it's called the adoption dynamics curve. So, for example, if we could shift this upwards, right? I'll talk about like how that might happen in a second. But if we could shift this upwards, we would see we'd have a new carbon-based equilibrium here, which is actually now at a higher level of electric vehicles. And we have a tipping point here, that I'll call A prime, which is now at a lower proportion of electric vehicles. And crucially, it's closer to where our carbon-based equilibrium is. And then we actually have a new electric vehicle equilibrium up here at B prime. And so the kind of crucial thing about this change of the shifting upwards of our adoption dynamics curve is we've brought our carbon-based equilibrium closer to the tipping point, which now means we would need a smaller shock, right? A smaller jump in the proportion of vehicles to get past the tipping point and to be on the road to the electric vehicle equilibrium. Now, in terms of what this shock could be, so example in the textbook is a nice one. It talks about like a really nice electric vehicle model being released that suddenly gets people really excited about electric vehicles and suddenly lots of people buy them. But just like with the housing market and the sea ice market, what if we actually got a drastic shift upwards in the adoption dynamics curve? All right, in this case, we start here at point C, but now we can see that actually, if we start here at point C, then the next year we're going to have, let me call this P1, we're going to have P2, a really high proportion of people buying electric vehicles. And certainly a much higher proportion than we started with. So now we fast forward a year and we're maybe here at point P2 and we go up to the adoption dynamics curve. And what do we see? We now move to an even higher level the next year. And this is going to carry on and on and on. And it's actually not going to stop until we reach this new electric vehicle equilibrium, which is like way up here. And I think I've got it slightly in a dodgy point where, we're basically at 1. Everybody is going to have an electric vehicle. But in this case, because the adoption dynamics curve has shifted up so much, you can see it no longer intersects with the 45-degree line at any point apart from up here. So the only possible equilibrium now is this one with lots and lots of electric vehicles. So now the crucial question: how could we get the adoption dynamics curve to shift up like this? To shift up a small bit so that maybe a smaller shock gets us to the electric vehicle equilibrium, or to shift up a really big amount so that actually we don't need a shock anymore, we just are going to get to the electric vehicle equilibrium? Well, there's two ways, and probably a combination of the two is what we're kind of aiming for. One is to try and increase the green values of society, right? Make it so that people put like a higher value with owning an electric vehicle. And if everybody then kind of believes that everyone else in society is putting a higher value in having an electric vehicle, then even if we have a relatively low proportion today, then there'll be lots of people now who think, right, it's time for me to buy an electric vehicle. And so the proportion next year goes up. So that's one way we get there. Another way of thinking about why the adoption dynamics curve might shift upwards is to kind of go back to this diagram and to think, well, what if something could be done to make it so that the cost of operating an electric vehicle was lower, and actually, so that at a lower proportion of electric vehicles, we'd hit that break-even point. So even if the green values in society stayed the same, people would be more likely to buy electric vehicles because now the cost is getting closer and closer to the cost of running carbon-based, petrol-based cars, basically. So in reality, we probably have a combination of these two things happening in society. And so what we're hoping is that this is what's happening, that the adoption dynamics curve is shifting upwards, and that we are getting the new carbon-based equilibrium to be closer to the tipping point, which means a smaller shock is required to get us up here. Or if the adoption dynamics curve shifted up enough that we wouldn't actually even need a shock, we would just immediately start moving towards the electric vehicle equilibrium. So that is the final kind of use of these S-shaped dynamics curves. And yeah, that is where I will leave it for this unit.